Hi, this is Mark Chandik, and welcome to this edition of Prosperity Perspective. Today, we're going to talk about what you need to know about long-term care insurance. Seems like everybody wants to talk about long-term care. They all have horror stories of someone they know personally or a story that they've read about a person that has had a catastrophic event. Might be a person that's had onset dementia and then moves on to full onset Alzheimer's. They need to be in a full care facility for the rest of their life, and the cost of the care is so expensive that it erodes the savings of that person down to nothing. That is the worst case scenario, and unfortunately, with current demographics, with the aging of the population, it will only increase the amount of these kinds of stories. It's important for you to understand what long-term care insurance is and what it's not. So let's start at the start. What is long-term care? What is a long-term care event? First, it's custodial care that you receive in a nursing home, or care that you receive in an assisted living facility, or home care, where you're taken care of by a medical professional or a family member. The most common reasons that people need long-term care are illnesses like cancer, stroke, heart disease. They can need long-term care because of an injury like a bone fracture or spinal cord injury, or simply the process of aging, which of course includes dementia and Alzheimer's. Statistically, what is the probability of needing long-term care in your lifetime? Well, 7 out of 10 65-year-olds will need some type of long-term care services during their lifetime. The average long-term care claim is made at age 83 and lasts almost 4 years. The cost of care can be astronomical and devastating financially if not properly planned for. For example, in the state of California, home care costs on average $5,700 per month, and full nursing care is almost $12,000 per month. Inflation for these services is higher than the regular inflation rate. In fact, we use a 6% assumption on inflation for these services. For example, if someone is 65 years of age and needs services at age 83, full nursing care is estimated to cost $20,000 per month. If this individual will need care for the average duration of 4 years, we're talking about $1 million expense. So now that you know what benefits long-term care insurance provides and the statistics of having an event, let's take a look at what options you have to shift the risk from yourself to a third-party insurance company. Long-term care insurance is highly regulated, and all policies have to contain similar provisions. For example, in order to qualify for benefits, you need to have a physician indicate that you need help with 2 or more activities of daily living, also called ADLs. Those activities include dressing, eating, transferring, continence, toileting, and bathing. You also qualify if you have cognitive impairment, such as Alzheimer's or a stroke. So once you qualify for benefits, you may ask yourself, isn't there coverage under Medicare? Well, there is, but it's for a maximum of 30 days. For example, you may have a stroke and you're in the hospital. They give you immediate urgent care for that event, and you're then released to a facility adjacent to the hospital because you need to receive around-the-clock care. Medicare runs out after 30 days, so you'll need to either be cared for at home by a professional or loved one, or stay at some type of facility. The cost of that care is your responsibility. Let's shift now to what your choices are in the marketplace to shift this financial risk. This video is not intended to get into the details of these 3 strategies because they're complicated and involve insurance products. So I'll give you an overview. Let's talk about the first strategy, which is to purchase a standalone long-term care policy. This option is similar to an auto insurance policy in that it's a use it or lose it type of concept. For example, if you don't get into an auto accident, you don't use your insurance policy. Likewise, if you don't have a long-term care event, you won't be using your long-term care policy. Unfortunately, in California, there are very few insurance companies remaining in the market that offer this type of policy. The primary reason is that 20 years ago, when long-term care first came out in the marketplace, companies mispriced the risk. They suffered big losses, and the result was that they left California marketplace altogether. Some of the companies that had guaranteed premium structures went to the California Department of Insurance and asked to increase rates. even though they were supposed to be guaranteed for lifetime, but they received permission to increase those rates. Insurance companies don't like to do that, but that's how wrong their mispricing was, which is why there are so few insurance companies available today. When you purchase a standalone policy, the pricing of it is based on your age and health status, but it is also impacted by how much daily benefit you purchase. If the cost of care is $10,000 a month, then you need to purchase $333 a day of benefit to equate to the $10,000 per month. You can also select the duration of benefits. I mentioned earlier that most claims are on average 4 years or 48 months. Lastly, you will need to decide if you want to add inflation protection, which will increase your daily benefits throughout the years. The second strategy combines life insurance benefits with long-term care benefits. This policy design is particularly effective when someone has a long-term life insurance need in addition to a long-term care need. The long-term care benefit is actually a rider on the life insurance policy and can be designed with the daily benefit and duration. So you are in essence buying a bucket of long-term care money. For example, $10,000 a month of benefit for 4 years is a $480,000 bucket. The last option available is a play on liquidity. What do I mean by that? This policy strategy requires you to shift dollars from your savings account and reposition it into a unique insurance product. I want to stress that it's not taking money from an investment account that is intended for retirement income. The idea here is that we are transferring from a low return interest-bearing account over to a long-term care policy, and you receive 3 specific benefits upon doing that. First, you receive a very small death benefit. Second, you receive a long-term care bucket of money. And third, you receive a premium refund feature. This strategy is arguably designed for someone who has the financial means to transfer part of their liquidity, and it utilizes the concept of leverage. In other words, every dollar you put in, the insurance company provides multiple dollars of benefit. So there you have it, the 3 basic strategies available in today's marketplace. Each is unique, and the one that's best suited for you is a factor of your own unique circumstances. A couple of closing facts. First, the average age of when people typically purchase long-term care insurance is in their 50s. Second, current tax law provides you with tax benefits on the amount of premium that you pay. Why do you receive tax benefits? The government is incentivizing you to purchase long-term care. I hope this video has provided you with some basics of long-term care insurance. Thank you for watching. If you enjoyed the episode and want to see more, please click the like button and the subscribe button below. Also, if you're interested in receiving a free copy of my book, please click on the link in the description of the video. I'll see you next time.